too, so dear trader. So in today's episode, we're going to talk about what would happen if the S&P reaching 6,000 points, and also I'm going to talk about my view on actually why I think we're actually the U.S. economy is not performing as well as what a lot of people have predicted, and there are some fundamental flaws, and also there are a lot of signals telling that there is a increasingly large divergence between the stock market performance and the U.S. economy fundamentals. So in this episode, I'm going to share my view and uh, perhaps explain why I think this could be a early bubble sign. So, okay, first of all, let's look at some bankruptcy news. So we all know, like, recently there are many fast food chain have been closing more shops uh, since like 2020 and 2020, and we are actually seeing more companies going bankrupt like recently. And most of these companies, we're talking about retailers. We're talking about pharmacies like Walgreens. So this is the headline: Walgreens to close up to a quarter of its roughly 8,600 U.S. stores. I know that Walgreens is not as popular as CVS, but still, um, Walgreens is still a big pharmacy chain, and we're also seeing a lot of more companies, food chains, major restaurant chains closed down across U.S. And right now, I'm currently in California, and the thing is, like when I go to downtown, that you're if you actually check the restaurants in LA downtown, there are more shopping malls closed down, and there are more like restaurants uh, having to close because of inflation and also because of the lower profitability. And you start seeing many places like LA and like many downtown area, it's increasingly difficult to run a business, especially restaurants. So now we are seeing like the reason why that I think the major restaurant chains are closing down is because like in California, like they have these policy of adjusting the minimum uh, labor wage towards $20 per hour. So for example, Pizza Hut and this kind of fast food chain, it would be a huge physical burden for them because the labor cost is increasing like a lot. Because you think about it, for running restaurants, if everyone is having like to work for long hours and $20 per hour, and that's going to create a lot of cost. And we're also talking about like the materials. We're talking about all the meats. We're talking about the ingredients. Because the inflation has gone up, and the cost of the supply chain and the cost of of making these food have skyrocketed. So we're seeing a lot of restaurants, for example, like this one, the very famous Red Lobster. The Red Lobster has filed bankruptcy in May, so which indicates a very strong economic signal, and also including TGI Fridays, Mob Pizza, Outback Steakhouse, Applebee's, and etc. Many fast food chains right now heading towards more bankruptcies. So, not for me. That's the case. If you are saying like economy is running well and you have more people spending, and if that's true, that you are not going to see these chain restaurants or pharmacy go bankrupt. And also, we're actually seeing like, for example, more retailers are actually facing bankrupt, and there are some like cheap business, for example, like Dollar Tree, has to increase their price in order to compensate for inflation. So the Federal Reserve and also the President Biden tells you that inflation has been tamed and controlled, but in reality, that's total different thing. In reality, we're seeing there are many like companies going bankrupt, like this one, Salt Life Beverage. So it's 50 million to 100 million asset. It's a beer company, a Delta apparel brand parent company, which worth $337.8 million. Basic Fun, toy brand, going bankrupt, and Chicken Soup for the Soul Entertainment. That's a big company streaming and DVD rental. So it's filing for Chapter 11, 500 million to $1 billion worth. And also Bakery June 21, Milk Street Cafe. The list still goes on. You can see In Coffee, Radio Small Business, Mel Bar and Grilled. So it's a $1 million business. So MRC, etc. So you start seeing a longer list of these company going firing like Chapter 11. And also, if we look at the expenditure number, it's actually decreasing a little bit, which is a good thing for America, for the U.S. economy, because like 68% of the U.S. GDP rely on like the consumer spending. So if you're actually seeing personal people willing to spend, that would be a good thing. But on the other side, you're seeing like people. The reason why people are spending more is because they have to, not like So that would be if you look at one data, and sometimes you tend to ignore other important information. So here, if you look at the delinquency rate on credit card loans, so you can actually see like the delinquency rate has bottomed on the Q4 of 2021, and now it's increasingly higher. So you are seeing more delinquency on credit card loans. People are maxed out their credit cards. People are actually borrowing money to spend. So definitely not a good sign. And yes, you're going to see more on credit loans. We're going to see like a lot of these default rates just going up. So the second thing I want to mention is that despite of the slowing retail number and also more bankruptcies, we are actually seeing the industrial output actually lower, because the ISM right now is trading at 48. The ISM actually indicate the entire productivity level in the U.S. And that tells you one thing, because the break even point is at 50. So when ISM is trading below 50, which is at 48, that tells you the overall industrial output of United States is be lower. Okay, so that's the fact, because during the last 10 or 20 years, the US has basically shifted most of its factories abroad, and that is the reason why the inflation is difficult to control up to now, because you have to rely on other nations, for example, like China, like India, to produce most goods, and because you have already outsourced these kind of industries, you have outsourced these factories. Of course, there will be pros and cons for doing so, but still, if you are having this inflation and you're putting a tariff on these products, you will cause a problem that you are going to put a markup or say premium on nearly everything that you're producing. So that's why inflation would be high, because you have to rely on other nations to produce you with the daily goods, and hence why you will have you will constantly, for the U.S. economy, it's constantly suffering the imbalances. It's a, because like for example, like China makes money out of U.S. trade. That is the direct consequence out of these um, imbalances, because you're paying more for the goods and daily goods. So that's the case. And except from that, the U.S. payroll growth slows, and right now the jobless rate slowly to pick up. And I've been saying something about like job market previously. I've talked about the payroll number. I've talked about how the Statistic Bureau actually made up with these payroll number, and how this is not actually correct by doing so. And now we're seeing some of the data become like, slower a bit. So the payroll rose 200,000 and 206,000 in June after steep downward revisions. So that's why people are betting that Federal Reserve is going to ease rate quickly in order to have a so-called like soft landing. But actually, what I think is, probably people gonna shift from soft landing to hard landing or no landing. I mean, this is just a confused term of understanding like economics, the status quo. I don't honestly, I don't think, that we need to spend more attention on these so-called lending thing, because the only thing, what we're gonna do, the bottom line would be when the Federal Reserve is gonna ease rate. I think that's the most crucial one. Instead of guessing that soft landing, hard landing, or no landing, I think it's best for investors just to look at the bottom line of, or to see the next move of Federal Reserve. So okay, so we are seeing the second quarter job market cools down further. So, like this data would just come back. We start seeing this trend. Like when you are like, this is what happened with Federal Reserve. Like every time when trying to make up some forecast, they tend to use, like data from last quarter, data previously. So it kinds of, for them, it's difficult to measure what is really going on right now. So when you're looking at all these bankruptcies, all these companies suffering, a lot of restaurants closed because they couldn't like keep hiring. So I'm living in CA, so I look around. There's a lot of food chains still hiring. There are lots of restaurants operating with very few people inside a food chain. Like we're talking about 3 to 4 staff serving like 100 people. Like that's insane. But if you look at the job number, it says like, oh, you have, wage growth. But then how come you have $20 per hour, but still unable to get you some working staff for restaurants? So that would be the problem, because like people are, maybe people are really lazy to work. B, because these is a problem. People, like the restaurant doesn't pay for the Medicare, and the increasing expense is not enough, even though like California trying to increase the minimum wage, but still not enough for people to have insurance coverage. So that's why people do not like to work in the restaurants, because that it often means very very long hour, very very dirty work, and very very tiresome. So, and C, well, a lot of people like actually, instead of working for the restaurant or fast food chain, and they prefer to work online, or start their own business. So you can kind of see this shift from restaurant sector, that it's creating problem with the restaurant business. So you are seeing like more people, running out of the restaurant and service industry, go to other industry. But it doesn't necessarily mean that it kind of boosts the job market. You just look around, like A lot of food chains basically rely on the Mexican worker and Latino, and like this is the status quo of the labor market. And one more thing worth mentioning is that because the fact that California has raised the minimum wage per hour, that's causing more restaurants to bankrupt. Because what do you expect from the food and beverage business? It doesn't provide a lot of profits. The profit is shrinking, and then you're enforcing these restaurant chains to increase their costs. What would be the consequence? The consequence would be more restaurants filing for bankruptcy, with no short, like no doubt. So last, I would like to mention because of previous two factors I have like mentioned in this video, like we're seeing some like fundamentals, like really strong fundamentals of um, why the U.S. economy fundamentals is not as strong as people perceive. Right now, we're going to see with the interest rate going higher, not necessarily higher, but keep it long, higher and longer thing. It will just cause more problem and more stress for food chain and also other business as well. So that's why the worst is yet to come. Like honestly, that I think the next must invest area is the reindustrialization of the U.S. And I have to admit, like AI is attractive, and I don't think AI is a bubble. But I think that with the Singapore reaching 6,000 points, we're starting to see the early sign of a fragile bubble. So, and I have no idea when it's gonna burst, but it may soon. Okay, so this is for this video today. If you like the content, please subscribe and leave a comment below. I'll see you next episode. Goodbye.